Welcome back to Money Matters. I'm Emily Johnson, joined by DCrowell, and we have been discussing all things where your money matters most relevant today. We've been discussing what's been going on with the stock market and this jump in interest rates and what that might mean for your portfolio, and the fact that none of us have tomorrow's newspaper, so we're trying to interpret what's going on and how it is going to impact us here locally.
And that segment was exactly what I was hoping it would do, because.
And if you missed it, you can go back and see it on YouTube.
You can go back and see it on YouTube. What Emily did was to show perfectly how difficult it is, and the relevance of the movement of the daily numbers and the weekly numbers in the economy and in the markets, and the complex interplay between them. There are some big conclusions that relate to our local economy and all of you. It is possible to state in general terms some conclusions. One of those is that if you are a baby boomer and you are 70 years old, or 69 or 68 or 67 or 66, and you're getting ready to retire, then you are the core constituency coming into the Bluffton-Hilton Head area. You who are already here know who I'm talking about, and you will know your friends back home in Ohio or Connecticut or wherever who are intending to come. Each and every one of those, now here's one of the big consequences, each and every one of those has experienced growth in their portfolio over the last year.
Hopefully. If you haven't,
if you haven't, then you should be thinking about who's managing the portfolio.
Mm-hmm.
But what did the Dow go up last year? 26%.
Now
Some
you put me on the
crazy
spot.
number.
Yeah, I want to say it was like 21, but I should
21, 24, 26. I mean, an enormous amount. The most conservatively run portfolio would have increased 5, 6, 7%.
Unless you were all in bonds. If you were all in bonds, you probably didn't have a very good year.
You didn't have a very good
and
year.
I've certainly seen portfolios that are all in bonds.
But what we're seeing on the retail side of the economy, and the mortgage side of the economy, as I look at one after another personal financial profile, is an increase in wealth over the last year for the incoming baby boomers, because they are invested in the markets. Mm-hmm. And with that comes decisiveness. Decisiveness occurs because of confidence. Confidence is the opposite of fear. And these are just as important as the hard numbers. You can't upend your life, make the move to Hilton Head Bluffton, and commence your retirement without making huge decisions. You can't make huge decisions without confidence. You can't. The antithesis of confidence is fear. I mean, all of these things stack up to make an economy here which is going to tick along very nicely, because that's the biggest component of
Mm-hmm.
it. That's what makes our engine run here. What's very interesting is that at the lower end of the housing market, which is a big part of our economy here, those houses got more expensive this week. Somebody who's wanting to buy a $200,000 home in Bluffton, created by one of the national home builders, that home just got $100 a month more expensive. Another way of saying it is that if you could barely afford a $200,000 home, that home is now a $190,000 home. There's interesting real-world consequences mm-hmm. from these numbers that are playing out on a weekly basis. Mm-hmm. Very interesting consequences. If we see an increase in housing costs, that impacts mostly the $100,000 to $500,000 buyers. The $500,000 to $500,000 to $1.5 million, $2 million buyers will not notice the difference. Why? Because they're winning with the left hand. They may be losing with the right hand, but they're winning with the left hand.
Right.
Somebody buying a $1.5 million place is probably in the market. So if the rates go up, so what? My portfolio went up. Mm-hmm. I'll just borrow I'll take more money out of my portfolio and borrow less. So there's a nice yin-yang. The person who's buying at the $200,000 level probably has no money in the stock market.
Right.
And therefore didn't experience a win, and therefore the only thing that they experience is the increase in the cost of money. So it's
Well, then there should also be an increase in real wages and that type of thing as well. Yeah.
Maybe. We haven't really seen the increase in real wages yet. Year over year, one of those stats that just came through was that real wages increased by 2.9% versus 2.6%
Right.
the year previous.
Well,
That's 0.3 of 1%.
it's still higher
That
than
is-
whatever our inflation rate is presently, so that's
I
in
know,
theory
but
good.
it's not enough to greatly impact the model.
It is. I do find it interesting how in economies like this that people are more confident, more willing to make decisions when you compare it to 2010, 2011, even 2012, where the shell shock was still there
Still
from
extreme,
the
yes.
Great Recession. People just unable to make decisions, questioning every decision, and we actually have to ask a lot of compliance questions. And one of the compliance questions that we ask is would you rather invest funds and watch them go down, or not invest funds and watch the market go up? Which would you prefer? It's like a lose-lose, but it's interesting. I think that actually most people would much prefer to sit on the sidelines and watch the market go up than to actually watch their money go down. I think it has to do with that confidence factor. And my armchair psychologist here is not qualified to have that opinion. But when I put that question to clients, in that way, usually they laugh first. But then when they actually think about it, it's usually the fear of the market going down. I think that's because people they're just frozen. They can't make decisions about the rest of their life when they're looking at all of this uncertainty. Just like if you have a big health scare, suddenly everything becomes really blurry, but it also comes into a sharp focus at the same time.
A sharp and narrow focus,
Yeah.
which prevents other big decisions.
Yeah,
That's correct.
and so we're seeing sort of the broadening of perspective, I guess. Not politically, I know, but the broadening of perspective for most people that are pre-retirees. Pre-retirees, I think, is probably a better way to put that. Folks that are still working, that are looking to cut back, that are maybe looking to sell a business, bring in a younger partner, something like that. That's definitely, there's more clarity around that. So that's happening, and also making more decisions about, okay, am I going to start putting more money into 401ks, defined benefits, and really stashing some cash because there's more confidence, which this is sort of a yin and a yang. There's more confidence, therefore there's more desire for the retail investor to go ahead and invest more money because there's more confidence around the fact that it's going to continue to be strong. So making those decisions too for the next 5 years before looking to retire. Those are all decisions that people seem to be more willing to make. I get a lot more calls and questions about those types of things now, of how can we really maximize, going forward, even though we're long in the tooth in this extreme bull market that we've been in.
Long in the tooth, but the good news from outside of Hilton Head and Bluffton is that the people who wish to come here, whatever family obstacles and family complexities that they have, are age-driven, and there's a huge age group of baby boomers who are pressing into retirement now. And number two, in most of the markets from which they are coming, their houses sell in 30 or 60 days. I mean, it's quite remarkable. Time after time after time, I see the house, which is an impediment to retirement, and I'm talking to somebody I have not met, I'm talking to somebody that I've made friends with on the telephone, and we're chatting about the financial strategy of coming down here and buying a place, and they've seen a place that they like down here. And my big question is always, well, when are you going to put your existing house on the market? Oh, we're not worried about that. Houses in our neighborhood go in 3 weeks. I mean, it's just amazing. It's just amazing. So
I hope my house sells
something like that, not exactly like that, but something like that is headed our way too. A tighter housing market with tighter turn times, with lower inventories, and hopefully some higher prices.
All right. We have lots to look forward to. Well, thank you very much for joining us this week. Please come back next week. Please check us out on Facebook. Send us an email. Give us a phone call. We love hearing from you. So until next week, this has been Money Matters. Have a great week.